There is a claim making the rounds right now that sounds airtight on the surface. The claim is that nothing meaningful has changed in the official gold reserve framework. The IMF is just doing routine technical housekeeping, and gold is still being treated exactly the same way it was before. And when you hear that quickly, it sounds clean. It sounds boring. It sounds like something you can safely ignore. But when you slow it down piece by piece, you realize some of it is solid, some of it is stretched, and some of it is people taking a handful of true facts and acting like the deeper institutional shift does not exist. That is exactly why I am making this video right now, because the paperwork changed before the narrative did, and I think you deserve the full story. I am recording this right now from New York, and I want you to comment what day and date you are watching from, because this kind of institutional shift moves slowly until it suddenly does not, and I want the timeline to be crystal clear. And real quick, if you value this kind of deep, no-nonsense breakdown of how the monetary system actually works, do me a favor, subscribe, and comment FinTalkOG so the algorithm knows you want more of this. Now, in case you have not seen what I am talking about here, is the claim making the rounds. Gold is still just a passive reserve asset. The IMF framework has not materially changed. Reserve reporting is the same. The monetary hierarchy is the same. Nothing to see here. On the surface, that sounds obvious. But when you traced where a lot of these dismissive takes were coming from, it turns out they are usually built on headline summaries and not on how institutions actually use rule changes in the real world. That is clean. It is also incomplete. Because the first place these stories usually get weak is that people hear the words technical update and assume it means economic irrelevance. That assumption gets investors hurt over and over again. So I am going to break down three things. First, what actually changes when reserve treatment, accounting language, and reporting structures get adjusted around gold. Second, why those changes matter, even if they look small on paper. And third, what it means for you if you own gold, are thinking about owning gold, or are trying to understand where the system is quietly moving. You are going to walk away calmer, sharper, and more in control of what you own. So let us start with what we can verify, because this is where the noise drops away. Gold in the global reserve system is not just another line item. It sits in this strange category where it is ancient money, modern collateral, political signal, and strategic insurance all at once. And because of that, small adjustments in how institutions classify, report, lend against, or operationally treat gold matter more than they appear to matter. Here is the clean way to think about it. If you change the flooring in your house, that is cosmetic. If you start reinforcing the foundation, even quietly, that tells you somebody inside the building thinks the ground might move. That is what reserve rule changes around gold look like. They are not flashy. They are structural. They are foundation work. Now here is what nobody wants to say clearly. Institutions almost never announce the strategic meaning of a rule change when it happens. They announce the technical language. The strategy is visible only later when you see behavior change. Recent institutional behavior tells you gold is increasingly being treated not as an embarrassing relic, but as high-quality strategic ballast inside a world where sovereign debt, reserve currency concentration, and geopolitical payments risk all look less stable than they did a decade ago. Let me be blunt. When the institutions that spent years pretending gold was just a legacy asset start quietly adjusting the framework around how it is held, reported, mobilized, and discussed, that is not nothing. That is signal. Now here is the skeptical alternative. Could this all be routine housekeeping? Could this just be reporting hygiene, system maintenance, and nothing more? Sure. It is possible. and I am going to say something that might annoy both sides. Not every rule tweak is a revolution. Not every document update means gold is about to explode higher. That is plausible here is how it can fail. The failure in that skeptical view is that it treats institutional systems like static machines. They are not static. They are adaptive. And when you see small, dry, technical changes happening alongside a long trend of central bank buying, reserve diversification, and sovereign concern about dollar dependence, you are no longer looking at isolated housekeeping. You are looking at plumbing work across the same building. And if you want to understand whether a scenario is building, you do not just watch one headline metric, you watch reserve reporting language, central bank balance sheet behavior, and physical gold flow data together. Stay with me on this, because it matters. Gold does not need to become a formal anchor of the system again to become more important inside the system than most investors currently believe. That is the middle zone everyone misses. People talk as if the only two possibilities are gold is irrelevant or gold is replacing the dollar tomorrow morning. That binary framing is nonsense. There is a huge middle ground where gold becomes more central as collateral, more respected in reserve composition, and more useful in bilateral confidence building between states without ever becoming the official public centerpiece. Same asset, different interpretation. Here is a question for you. Do you think gold needs an official dramatic announcement to matter more? Or do you think the real story is these quiet operational shifts that barely make headlines? Drop that in the comments because I read them, and that answer tells me a lot about how people understand institutional behavior. Now let us talk about why this matters in practice, because this is where the mainstream commentary usually falls apart. When reserve rules and classifications move even a little, portfolio behavior can change a lot. Think of a pressure valve, not a trap door. Markets do not always react with one giant vertical move the second the paperwork changes. More often what happens is that a subtle change lowers the institutional friction around holding more gold. It makes internal approvals easier. It makes reserve committees more comfortable. It makes the conversation inside sovereign institutions less defensive and more normalized. That does not look dramatic on television. But over time, it changes demand. And time is the weapon here. Because these institutions are not day trading. They are reweighting across years. A second practical implication is collateral confidence. In a world where trust in sovereign debt is no longer automatic and sanctions risk has become real for far more countries than just the obvious targets, gold's usefulness rises because it sits outside someone else's liability. Here is what nobody wants to say. A reserve asset that does not depend on another government's promise looks more attractive every year. The global system becomes more political. That does not mean treasuries vanish. It means the monopoly on unquestioned trust weakens. And when that monopoly weakens even a little, gold matters more. Now here is the skeptical counterpoint again. Could rising operational respect for gold still fail to produce a big price response? Absolutely. A correlation is not a contract. Gold can become more strategically important and still trade sideways for a period because price is also influenced by real yields, dollar strength, and liquidation events. That is plausible here, is how it can fail. What the skeptics miss is that even if price lags, the floor under the market gets thicker. Institutions create floors before headlines create momentum. That is what long-term positioning looks like. Now here is a simple action plan. No drama. Step 1, write down why you own gold or why you are considering it. Is it inflation insurance, monetary insurance, portfolio ballast? geopolitical hedge. Decide this first, then build around that reason. Step 2, stop reading reserve rule changes as isolated paperwork and start reading them in the context of central bank buying and reserve diversification. Do not make the common mistake of separating the document from the behavior. Step 3, if you want to understand whether this trend is real, track 3 things: central bank reserve commentary, physical gold flow data, and institutional language around collateral quality. Step 4, keep it sane. Gold is not a lottery ticket. It is not supposed to behave like a meme stock. It is there to do the quiet job that most people only respect after a system shock. Now let us map 2 plausible paths without pretending we can predict the exact candle. Path 1 is the quiet re-rating path. In this path, more institutions gradually treat gold as a more serious reserve and collateral asset. Central banks continue accumulating. The operational respect for gold keeps rising, and eventually the investment world catches up. Gold does not need a theatrical announcement. It just keeps climbing the hierarchy while most people are still waiting for fireworks. I am not predicting it. I am saying it is within the set of things this market is capable of doing. Path 2 is the delay path. In this world, the structural shift is real, but price response remains uneven because macro forces like a strong dollar, high real rates, or short-term liquidation pressure keep interrupting the move. Both worlds can be true at different times. That is not a crash call. That is a maturity call. Now here is the uncomfortable part. If gold is quietly being re-legitimized inside the reserve system while retail investors are still waiting for a loud official signal, that means the cheapest part of the institutional accumulation phase happens while most people are bored. And when retail finally notices, it usually notices after a move, not before it. Institutions protect themselves with time. You usually do not. That is why the defensive strategy matters. Here are the 4 rules. 1, decide your maximum allocation first. Write it down. If you are losing sleep, you are too big. 2, when something runs hard and you are up a lot, take some off. Not all, some. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3, do not confuse narrative with mechanism. A bullish document does not guarantee a straight-up chart. 4, the best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here is what we covered. Quiet rule changes around gold matter because they reduce institutional friction. Reduced friction changes behavior. Changed behavior creates demand floors before it creates headlines. Gold does not need to formally replace the system to become more central inside the system. And the real story is not the press release. The real story is what institutions start doing once the paperwork changes. Stay alert. Stay sized appropriately. Do not let the dryness of the topic fool you. Foundation work is boring until the building starts moving. Now here are my questions for you. Do you think the IMF and broader reserve system are quietly giving gold more operational respect than most investors realize? And are you holding gold mainly as insurance or because you think the system is slowly repricing it upward? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when the next reserve or institutional reporting shift shows up. And if this helped you, share it with someone who still thinks gold only matters if somebody announces a new gold standard on live television. Stay sharp, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.